We are getting breaking news as well. The Fed's semi-annual monetary policy report has just come out. I want to bring you some of the headlines. We see that the Fed is saying the labour market is near or a little beyond full employment. That's a direct quote. Also that the pace of wage gains has been moderate and held down by low productivity. They're probably the two major portions of the monetary policy report that we and the market will want to be concentrating on. Talking about the banks as well, says that US banks are well capitalized with significant liquidity, so that would seem to damp down any concerns that there might be about liquidity in the system. Let's get some context now on this monetary policy report. The first under our new president of the Fed, or a new Fed chair, Jerome Powell. Let's bring in Stephen Stanley, chief economist with Amherst Pierpont Securities, joining us from Stamford, Connecticut. In the context, Stephen, of what we've heard over the last couple of days from Fed officials, and then of course the FOMC minutes, what strikes you about some of the headlines I just read out?
Well, I think one thing to keep in mind is it's a little bit dated, because that policy report, as well as the testimony that we're going to get next week, is really focused on conditions as they were at the end of January at the last FOMC meeting. And of course, February has been quite eventful between the volatility in the markets as well as the high wage and price numbers that we've gotten.
Stephen, what do you put the emphasis on in the last couple of days? Because we have got some more dovish talk from a couple of Fed officials in the last couple of days, which would seem to not jibe so much with the FOMC minutes.
Yeah, I think the Fed is largely on track for, the gradual policy rate hike approach that they've had since the end of 2016. The dots call for 3 moves. There are a few people that are looking for less, a few people in the Fed looking for less than that, and a few looking for more. But I think there's a pretty strong consensus now around that 3-dot approach for the moment.
Stephen, the dots point to 3 moves. Is there more of a risk that we get 4 or 2 this year?
I think definitely 4. I actually think we're going to get 4, and it's interesting. There are more and more private sector economists who are moving in that direction. I just think the economy is, as the Fed themselves acknowledged, we're beyond full employment. I think we're certainly at risk of the economy overheating a little bit here. And I certainly think we've seen plenty of evidence in recent months that wages are starting to pick up finally, and I think we're also going to see a pickup in inflation this year. So I think the Fed might feel motivated as the year wears on to get a little more aggressive.